Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me today to weigh in on market action is Tai Wong, independent proprietary trader. Tai, good morning. Great to have you here today.
Remy, good morning. Great to be here. Beautiful day, beautiful fall day here. And it's October 3rd. It's actually the first day of year 5785 on the Hebrew calendar. And when I think about that, it's like, Happy New Year to our viewers who celebrate. It's wow, almost 6,000 years. That is just a lot of history. I have great respect for that. And it's even longer than the Chinese, which I think we're only about 4,800 years, of our calendar.
Yeah, that is significant when you think back to how many years we're actually talking about. So as we kick off today's session, though, we're keeping an eye on the latest economic data releases. And tomorrow morning, by the time you and I are on air, at 11 in the morning, we'll have that big U.S. jobs report. But we did see U.S. jobless claims come in this morning, slightly higher than forecast. And we also did get that ISM data point, which did come above expectations.
Yes. Yeah, so jobless claims were up slightly, like I think 5,000 from the week before. The continuing, the average claims over the past 4 weeks, which people like to look at because sometimes the week to week can be a little volatile, is pretty flat. Generally speaking, most people are pretty happy with jobless claims between 220,000 and 230,000. It's sort of the numbers that get north of 240, 245,000, which we've seen in recent months that give people a little nervous. But where the economy is right now, the market is pretty happy with it. The ISM report, which just came out at 10 o'clock, the services ISM, was really a little bit more of a surprise. I think that ISM services number came out at, business activity was quite high, almost 60 from previous 53. Prices were high, and the services PMI was the highest it's been in over a year at 54.9 versus the consensus of 51.7. So what this means, it sort of makes the job of the Federal Reserve maybe a little harder because they're trying to look at all the incoming data, and this isn't as important as the employment report tomorrow. Maybe not as important as JOLTS, but certainly they're thinking about prices paid sharply higher. Is this something in the pipeline? And we've been talking a lot about this port strike. So this is something that will maybe not immediately, but as it progresses, and I think it's got some time to go, become more in the public's mind as well as in terms of the policymakers.
And of course, as you mentioned, we'll be keeping an eye on how a lot of these events that are unfolding here in the U.S., especially along the coast of the U.S. on the east side as well as the Gulf Coast with this ongoing strike, how it affects jobs figures, the labor market, and if it does last beyond several weeks, the implications on inflation as well.
It's sort of like when you drop a pebble in the water and you sort of get the ripples. And we're really not quite sure, how the ripples are going to exactly flow out. Because dock workers not working, all the economy that supports around the docks, the people who make lunch, the people in the carts, they're getting hurt. So we just don't. Sometimes the farther out you go, there'll still be ripples. We just don't know where it's going to be.
Yeah, it's very akin to what we saw during the pandemic when people had to work from home, and even as people started working back in their offices here in New York City and across the U.S., we saw that all the businesses that relied on these white-collar workers coming into the office place, they were also affected as well. And even here on Wall Street, when you think about all the businesses that used to be down here for decades and now they're gone, we see how that affects small businesses and employment across the country.
It really, a lot of big changes in terms of what the pandemic did was I think it made people a little more casual. So the people who make dress shirts, Brooks Brothers flagship store is gone. The boot blacks who are in Grand Central, I mean there's one or two left, but if you look around the floor here, everybody wears sort of rubber soled shoes or sneakers, and it's easier if you're walking around. That wasn't true, pre-pandemic or even 10 years ago. Everybody was in really nice dress shoes. The boot blacks were really busy. So when you I guess it's the law of unintended consequences. You do something, and what you worry about are sort of the unknown unknowns. If I do this, what's going to happen that I don't see? And sometimes it's sort of the opposite of what you expect or want to happen. So I don't know if they'll be true with this port strike, but certainly, things that freight costs have already been moving higher, and this is going to be more, worsened by having to direct ships further, further to the West Coast or wherever it might be. Just as an example of all this trouble we've seen in the Mideast in recent years, on a monthly basis, ships that pass through the Egypt-Suez Canal is down about 2/3. It used to be 2,000 ships a month. Now it's 800 ships a month. In part, it's because the Houthis who are controlling Yemen have been attacking a lot of ships. And when you attack ships, there are European navies and the U.S. Navy is trying to keep things safe. But if the crews feel like they're at risk and the crews are in danger, and some maritime crews have lost their lives, not many, but still, once the lives of the crews are in danger, the shipping companies like, we can't, we're going to have to route away around the Horn of Africa, which is a much longer trip, which is why they built the Suez Canal. So, I think look for freight rates to continue to, move higher as this port strike progresses.
And when we think about the U.S. consumer as well, there are some concerns. You and I were looking through some of the local tabloids to see what the temperature was. And I think in this day and age of social media, there are a lot of people, the second they hit supermarkets and see empty shelves, perhaps it brings back memories of the beginning of the pandemic, and that is concerning to some. But realistically, when can we expect any changes in terms of consumer goods or perishables?
I think we'll see probably it happen in pieces. You mentioned yesterday you didn't find eggs at Wegmans, and I found eggs sometimes are a little spottier at Costco over time. They're usually there, but sometimes they're not. And I bet that there are memories of people who are probably like, I'm going to get some toilet paper just in case. So, although I have to think that toilet paper is probably manufactured here. That's big and bulky and not very heavy. Do you really want to ship that on a container? I like to think not, but all it takes is, like you said, and sometimes the tabloids are great, but because, New York Post, a favorite of mine, I mean, I think they have the best headline writers in the business. But, it takes a few photos of that, and people look at it like, oh my, I've got to worry about this. And these anecdotes are, if anything, the ones that will probably get this strike over more quickly, because people are going to say, they're running out of toilet paper. We can't have that in front of an election. And we get to the tabloids. I think the head of the ILA, Harold Daggett, is getting a lot of unwelcome attention. Matter of fact, the New York Post flew a drone. I think it was the Post, but they certainly reported. I don't know if they did it, but they flew a drone over his house in New Jersey. And I have to say, I don't want to get into it, but he lives in an awfully nice place for, the head of a union, and apparently he makes almost $1 million a year. So as stories like this sort of circulate, it makes, maybe maybe you should take the 6-year 50% rate increase, and that's pretty good, and not hold out for 77%. So we'll see how it plays out, but it really is, the tabloids in cases like this become important because they disseminate news, and, if it bleeds, it leads. But in this case, the more eyeballs it catches, the more attention it gets.
Well, in terms of some of the headlines we're talking about in the New York Post here in New York City, I think they do indeed know how to draw in the attention of the viewer and make them want to click on some of those headlines. And I think, just the fact that you're talking about the size of this leader and how big his home is, he probably doesn't want that kind of attention or press getting out, especially while there's a strike ongoing.
Yeah, and it's bad for the rank and file, sort of, we don't have paychecks anymore, but you're kind of living well there, bub.
Absolutely.
So it was really, really interesting, and it's appearing in the Journal. So it really, I think his reputation, I don't think maybe he expected this much attention. But it's a big strike, and they're asking for a lot of money, so, sometimes you have to expect that, the spotlight might not be as welcome as you think it might be.
Absolutely. And when you have media focus like that, we know that there's going to be a lot of unwanted attention, and we don't know what kind of attention it's going to be. So it'll
Yeah.
be interesting to see what happens as the strike
Sure.
continues. And of course, ahead of tomorrow's jobs report, we're keeping an eye on the US dollar. So in terms of today's trading session, there's been focus on the Japanese yen as well as the British pound. In New York morning trade, we are still seeing the British pound lower against the US currency about 1%. And dollar yen is still slightly higher, right around the 146.70 level. So what do you make of the action we're seeing this morning in the FX markets, Tai?
So if we remember, it wasn't very long ago. Might have been not even 2 weeks ago. We were talking dollar yen was traded on a 139 handle, and all of a sudden we're at 146, 147,
Yes.
and the strength in the dollars against the yen, or we could say the yen weakness, has actually really helped the dollar index, which is consolidating reasonably, not that far off the lows, but certainly off the lows, and. For the new Prime Minister Ishiba came out and said, "I don't think we need a rate, we need a rate hike this year. I don't think the economy is ready for it." Another board member came out and said the same thing, and I think that puts the Bank of Japan in sort of a delicate situation where they said, "Okay, we do have memories of this generation-long deflation. We don't want to repeat that." And fundamentally, the Japanese population is shrinking at sort of a relatively accelerating rate. So you are worried about getting back into a deflationary spiral. So it seems increasingly likely that the Bank of Japan is not going to hike again this year. I don't think we're certain about that. Probably not the end of October, and we'll have to look at December. But more people are coming back into the yen carry trade, saying, you know what, if the U.S. is only going to cut another 25 basis points in November, or maybe a total of 50, and the Japanese are not going to hike. There's a lot of extra 4.5%, 5% dig in here, and it's worthwhile. I don't think dollar yen is heading back towards highs, but I think it's definitely consolidating at a level comfortably above 140, and that's helping the dollar overall. And in part, something we haven't looked at in a few days, but precious metals, gold remains within 1% or 2% of the highs, but has sort of lost some of the energy that we had when it was charging the historic highs. I don't think it's going to dip very much, and it may even find buyers, bargain hunters, if we get towards the 2,600 or below, which is possible. We get a strong employment report, but that's still a buy on dips for gold and probably also for silver.
And before we move away from what we're seeing in the other markets, since you mentioned the dollar-yen level and where we are right now, especially on the eve of the jobs report, I do want to take a step back and talk about the unwinding of the carry trade and what we saw on August 5th, because that came on the heels of the unexpected rise in the unemployment rate here in the U.S. So what do you think the risks are right now?
So I think J.P. Morgan reported that they thought maybe 3/4 or more of that carry trade unwound in the days and weeks following August 5th. I think some of that has probably come back. And it doesn't look like we're going to get, from all the indications we've seen, the jobless claims, which were fairly low for the survey week that's responsible for the employment report that we're going to see tomorrow, and sort of the jolts and other sort of contributing factors, doesn't seem that we're going to get a number that's going to be very, very different from consensus. In fact, I think they're looking for last month it was 140,000. This month the consensus is around 142,000. I'm actually interested to see whether or not the revisions go flat. I don't think I don't get the feel that it's ready to. We're healthy enough to have revisions go higher. But if revisions are only slightly lower, or if they go flat, I think the thinking continues to change. So I think the yen carry trade, I don't think we're going to see something like August 5th again. Certainly, it could easily move a yen, maybe even two, if there's a big surprise one way or the other. But I think it's in an area where it's relatively comfortable. Which brings to mind, actually, one chart I was looking at earlier today, and it's a little troublesome, is for Bitcoin. And Bitcoin's one of those where it really is sort of this S&P 500 on steroids a little bit, had been rallying aggressively, broke out of that long-term downtrend that I was, year-long downtrend that I was concerned about. But now it's, went from 65, 66,000. We're just barely above, around 61,000 now, and it looks like it might slip back into that downward channel, which wouldn't, be good for too many of our crypto our crypto friends. So tomorrow's data is going to be important for that. Is it going to continue to go sideways, or are we going back to, lower highs and lower lows? I'm a little concerned that we could be headed in that direction. So a false break.
And since you brought up Bitcoin and the risks following the U.S. jobs report that are coming out, I think for our viewers it might be very helpful to talk about why sometimes bad news is good news for the markets. How does that actually work?
So it seems strange to most folks, but right now good news is bad news because the Fed is undecided how much to cut. So when there's good news, stronger employment, a stronger economy, they're less likely to cut, which makes it bad news. It's good news for Main Street, but it's bad news for Wall Street. And we're sitting right here on Wall Street. Bad news for Wall Street because we don't get the turbocharged fuel that we can get. That we can get bonds higher and stocks higher and Bitcoin higher. So we're very much in the area now where good economic news is bad news for the markets. That won't always be true. Once I think where the Fed is sort of stable, let's say the Fed says, all right, we're down to, in a year's time, we're down at, say 4% in the Fed funds rate, and we think we're at the right place, then good news becomes good news again, and bad news becomes bad news. But when policymakers are trying to decide what's happening, and they're not at an equilibrium point, because nobody thinks that that 5% Fed funds is 4 3/4 to 5% is equilibrium. That's when news really matters, and you get messy things like. And in fact, my son, it's so funny you asked that. My son asked, it's like good news is bad news. You're exactly right. And for people who don't follow the markets, it might not necessarily be true. So I think this will be true for some time because the Fed is. I don't think the Fed will be done until probably the end of next year or get to a place where they want to be, wherever they think the neutral rate should be. I think they want to be at the neutral rate at the end of this and not below it. But as you say, it's a little strange for people who are on Main Street.
Yeah, I think it's very helpful to dissect that because we hear that often when there is good news, then it's bad for the market. And we know that the stock market is not the economy and it's not Main Street. But I think sometimes it's so helpful to break down what the meaning is behind some of this lingo that we often bring up in our conversation.
No, on your point about talking about stocks, one thing I looked at today was the Chinese have been on holiday since October 1st and won't come back till middle of next week. But I took a look. Let's take a look at graphic 2 if we can. I took a look at FXI, which is the ETF that follows the Chinese large cap stocks, and on the right is where we are as of close yesterday. You can see that that little red bar is the last day of the Chinese, when the Chinese markets were open. But these are ETFs, so Americans are buying these sight unseen without guidance from the Chinese market. As you can see that it was up yesterday sharply. Today it's sort of a little bit unchanged, but I would note that the Hang Seng, which has followed the Chinese market, is down 1.5% today, and it's the first substantial drop since the Chinese stimulus measures. So it'll be interesting to see middle of next week when the Chinese come back, if with a week to think about it, are they still as excited, or do they say, well, listen, we made some money on this, and it's time to take a little profit. I don't think it's going to drop sharply, but does it consolidate? Is there some profit taking in there? And just for a guide, the little chart on the left is the dramatic rise in the Chinese benchmark in the 5 sessions before their holiday. You can say that it's straight up and gaps in the middle, similar to the chart on the right. So I think the view here is we'll still get some more energy out of the Chinese when they come back, but I don't know how long it'll last. So something that we'll keep an eye on.
And Tai, since you mentioned overseas markets, I think it'll be a good time to do a market check for what we're seeing in the major U.S. equity averages. So right now we are seeing all the major equity averages in the red. The Dow Jones Industrial Average does remain in negative territory and is off by nearly 230 points or 0.5%. The Nasdaq Composite Index is also in negative territory this morning, off by 0.2%, and the S&P 500 is also lower in today's session, down by nearly 0.3%. Now, Tai, we've covered a lot of topics, but I do want to very quickly talk about artificial intelligence and OpenAI's latest raise and valuation. So not too shabby, huh?
Not at all, not at all. Worth, they came $6.6 billion they raised, which puts the valuation at $157 billion. Yeah, pretty impressive, and some of the the usual names are in there. Thrive Capital led the raise. I think they put in over $1 billion. Microsoft, which has has put $13 billion in OpenAI, put another $750 million. SoftBank, Masayoshi Son put in another $500 million. So this is still really, really popular. But in recent days, I've seen some articles saying, we're investing, and the market's investing tremendous amounts of money, billions and tens and maybe hundreds of billions of dollars into building out AI. How much is it really, really going to change? And there was an MIT Institute professor who came out with an article the other day saying, I think it's going to really replace 5% of the jobs completely. So there could be a lot of potential for some over-investment there. It's still early days, and Jensen Huang of NVIDIA is saying that the demand for their Blackwell chip, which is one of their big AI chips that can handle these, all these operations, has been, I think his words were, insane. So I think it's going to go on for a while, but at some stage you do have to show what are some of the results. We put in so many billions of dollars. Where are the results? I don't think this is going to happen this year, but at some point, perhaps early next year, I'll say, well, what kind of returns are we getting for it, and how long do we continue to invest before we want to see something? In terms of just market sentiment, for Tesla is about to unveil, I think within the next few weeks, there are plans for a robo-taxi and automated driving. And if that's, kind of a knock your socks off or impresses the market, the idea that, I can sit in my car and, my car drive myself in the city and I don't have to worry about, all the traffic, and I'll just do my work, I think that will actually help AI a lot. Not, directly AI, but in terms of what's going to hit the tabloids, what's going to improve the mood, that could be very important.
Well, autonomous self-driving vehicles here in the U.S. are not as common as in some regions in Asia, and even when we're talking about the San Francisco Bay Area, that market is fairly limited. But what is your take on these types of vehicles? How long do you think you will need before this technology is up to your standards for you to feel comfortable?
So I'm a Gen Xer, so I'm a late adopter of of most things. I like to see things work before I do it. So I got my LASIK surgery in 2007. That's about 20 years after it really started, because I wanted to see how everybody who got in the first round, if their eyes were still working a little bit later. And I'll tell you what, it's been the best thing. I mean, I've had perfect vision from 2007 until now. And I needed some reading glasses the last year or two, but that's age and not the surgery. I think I'll eventually get a hybrid car, but I want to see how it sort of the first, second generation works out. But I could see myself doing that, where it's an ICE engine, but it charges a battery, and I get 60 miles to the gallon. So automated cars, I saw I think a Waymo one out in Arizona, and I didn't get a chance to get it when I tried. But I think once people get a feel for it and they're actually in it and it's safe, I think adoption could go up a very, very sharp curve.
Well, I think personally I feel the same way when it comes to these types of vehicles, especially given some of the stories that have made headlines and tabloids as well. So, Tai, thank you so much for joining me as always, and tomorrow morning we'll be talking about that jobs report.
Absolutely, great to be here.
Thank you so much, Tai. And coming up next, we have Steve Milunovich, who is a retired technology analyst and member of the Institutional Investor Analyst Hall of Fame. After the break, we'll be back, so don't go away. Welcome back to Global Money Talk, live from the New York Stock Exchange. Joining us today for a market insight on the technology sector is Steve Milunovich, retired technology analyst and member of the Institutional Investor Analyst Hall of Fame. Steve, great to have you at the New York Stock Exchange. Thank you so much for joining me.
Oh, thanks for having me. I appreciate it.
Well, I understand that you began your career in terms of tech analysis back in 1983, and one thing that I think about when I think of 1983 is the launch of the Apple Lisa computer. So a lot has changed since then, especially when it comes to technology. We've had the advent of many new entrants when it comes to tech. So give us a little background in terms of your career.
Sure. So as you said, I started in 1983. Research at that time wasn't the place most people wanted to go work. In fact, it really didn't recruit on campus for research analysts. And yet I knew that's what I wanted to do, so I just blanketed Wall Street and managed to get a job at First Boston. And they said, would you rather cover coal or mainframe computers? And I didn't know much about either, but I figured mainframe computers probably had a better future. So I've seen many cycles, and that's what we're going to talk about today, is kind of the evolution of technology over time. And I was on the sell side. The sell side, of course, covers companies in a very concentrated way and puts together ideas for the buy side, the mutual funds and hedge funds. And although there's a lot of focus on our stock picks, the sell side really act as consultants, if you will. And so we had to think, fairly big picture, but then also bring it down to the company specific level. A lot has changed technologically in terms of how a research analyst does their job, but as I look at it today, a lot of it's the same. People are still writing reports, still visiting companies, and technology, if anything, has certainly become much more important than when I started.
And you bring up an important point, because we think about the way that all of us use technology now and the access to a lot of these operating systems. I'm sure that has changed significantly since you first became an analyst. And because you've been through so many cycles, when it comes to technology, how do you look back on the different cycles? And could you enlighten the viewers in terms of what that looks like?
Sure. So I've got some slides that we can take a look at to look at the evolution of technology. So if we start with slide 1, this is a 60,000 foot view of the industry. So this is actually from a book by Carlota Perez called Technological Revolutions and Financial Capital, written about 25 years ago, but fairly influential. And she argues that technology drives the economy, and it does so in long-term waves of 50 to 60 years. So you can see she goes all the way back to the Industrial Revolution, the age of steam and rail, and so forth. And she divides that 50 to 60 years into two major periods. The installation period, which is one of high invention and innovation. Essentially these days we would call it a period of disruptive technologies, new technologies coming up and starting to disrupt the status quo. It also tends to lead toward the end of that installation period to a frenzy, or these days we would call it a bubble. After the bubble, you get the deployment period, and that's when these new disruptive technologies permeate the economy and create real productivity improvement. Particularly in this first period, the synergy era, that she also calls that the golden age, if you will. And that's, I think, particularly when stock investors most benefit from these new technologies. Now, if we look at the current age of information, she starts that in 1971, which is when Intel created the microprocessor. So we obviously had, gradual growth, and then in the 90s, tech really took off and ended up with the dot-com bubble. So in this era, that would have been the primary bubble. From there, it gets a little bit cloudy, because you could argue we also had a bubble with the financial crisis, which is more about mortgages and housing and so forth. But arguably, we are perhaps now in the deployment period and perhaps the synergy period. If you look at tech stock performance, certainly, and we will, it's been incredible over the last 10 to 20 years. Now, will artificial intelligence, which we'll talk about as potentially the next wave, really lead to a long synergy period before we get to maturity? Hard to say. So this is very long term, but it's good to think about 50 to 60 year waves. If we go to the next slide, we can start to get a little bit more practical. And this is looking at 10 to 15 year shifts in technology, often product driven. The trick in technology has been to basically identify the winners in a new 10 to 15 year wave and exit the older companies. The older companies don't go away, but the growth migrates to these newer names. So as you pointed out in the 1980s when I started, it was really about mainframe computing, and then it was the PC with Compaq and Dell, networking with Novell, putting those, communicating those PCs together. And then, of course, we went into the first age of the internet, which was the desktop, which led to the dot-com bubble. And then perhaps beginning with the Apple iPhone, the mobile internet took off. And the last 10 years or so have really been about cloud and SaaS, software as a service. So it's been a very software-driven last 10 years. The question now is, what's the next wave? And over the last 5 years or so, a lot of people have been trying to guess that next wave, right? Because it's so profitable if you get it right. And it was, crypto and NFTs at first, and that didn't really happen. And then it was Web 3.0, and that's not really happened either. The consensus now is that it's generative artificial intelligence, and we'll talk more about AI. But that's the consensus in terms of what the next 10 to 15-year wave is. So you want to be looking for potential winners there.
And I think it's very helpful for all of us to take a look at these different cycles that you have mentioned in your slides, because when we think about how AI has become a hot investment theme, we think about how many decades have passed since that has come on the horizon. So I think taking a look at all these cycles is very helpful. I know you want to talk about what we're seeing right now and how to identify these names. So how do you go about doing that?
Sure. So on the next slide, slide 3, I just do want to point out that each of these waves results in a different group of companies really succeeding from a stock market standpoint. So these are the top 10 market caps by decade, going all the way back to the 80s when IBM was dominant, into the 90s when the Japanese were supposedly going to take over the world. That didn't really happen because they didn't have the software expertise. Then, of course, we had the dot-com bubble. Cisco was the second largest market cap, and I covered Cisco at the time, and I remember we wrote a report saying if Cisco grows at the expected rates at that time, it's going to be a third of GDP in 30 years or something crazy. So you knew things were overdone. 2010 to 2020, we've had a big jump in market cap, and that's been that cloud SaaS era. And then you can see that with your help, we've just updated this recently, so you can see the current market caps. Apple still is the largest by a little bit over Microsoft. NVIDIA, of course, has come out of nowhere. And you've got other new names like Tesla. And I think our audience will be interested to see Samsung Electronics there. Samsung was there in the 2020 period as well. Still incredibly important for its semiconductor and consumer electronic franchises. So these are the names associated with the waves. And again, the goal is to sort of figure out who's going to move up and who's going to move down. Now, you were asking a bit, if we go 2 slides later to the 7 powers, you were asking, what do we look at to sort of determine which companies we might be interested in investing in? So I'm not here to give specific names today, but again, to provide a framework. And there's a lot of ways you could look at company selection. But one of the frameworks I particularly like is the so-called 7 Powers strategic framework. Hamilton Helmer wrote the book 7 Powers. He was a professor at Stanford as well as a money manager. And he argued that a power is really finding a strategy that gives you sustained differentiation, right? From a financial standpoint, we would call that a high return on capital. And the green squares here indicate the powers, the 7 powers. So just to quickly enumerate them, you've got pretty obvious things like scale economics. So the bigger you are, the lower cost you can provide your product or service for. You've got network economics, which are incredibly important these days. Network effects, if you will, really have allowed these new companies like Google and so forth to get as big as they are, because the more customers you have on one side of your platform, the more you get on the other side of the platform. Switching cost is a big one in technology historically. You're usually locked into a company's architecture through software, like the IBM mainframe, which is still around today. And then you've got ones like process power, maybe TSMC, or some of the semiconductor companies have that in terms of their semiconductor process being proprietary. A cornered resource where you have proprietary access to an asset, perhaps like Corning with Gorilla Glass. And then the final 2, counterpositioning was Helmer's favorite power. It's basically going opposite the leader. So if you come into a market, do you copy the leader? Probably not going to work. So instead, you do the opposite of the leader. I used to work with a couple of marketing strategists, Al Troughton and Al Rees, who were very well known for creating the term positioning all the way back in the late 1970s. And they said business is a battle not in the marketplace but in the customer's mind. You have to get into the customer's mind. And they said if you're not the leader, you want to go opposite. So for an example, historically would have been Avis. So think if you're going in the rental car market and Hertz is there and they're by far the biggest and the best, what do? Do you try to copy Hertz? Well, no. Instead, what you say is we try harder. We're number 2, so that's believable, right? We have to try harder. And then you point out, hey, they're number 1. They have long lines. We have short lines. Why don't you go with us? So this opposite approach, I think, can be very successful. Another example might be Vanguard, indexing instead of managed funds like Fidelity, or even Tesla doing electric cars versus combustion engines. Branding kind of fits into that as well. Once you're established, you want to have a differentiated brand, as Apple obviously has. And at the bottom of this slide is the power by time. That is, when you start a company is when you have to decide, do I have a cornered resource? Am I taking a counter-positioning strategy? As you take off, you try to take advantage of network effects, scale economies, switching cost. And then once you're well established, then you focus on branding and process power. Just to think about applying these to a company today, let's think about NVIDIA. So obviously NVIDIA, in a sense, has kind of come from nowhere, although the company's been around for a long time. So I would argue scale economics, yes, they're the biggest manufacturer of graphic processing units, but is that really such an advantage? Probably not so much. Network effects, not so much in terms of having kind of, one side of their platform attracting the other side and vice versa. That's a little bit more of an internet phenomenon. Switching cost, I would say, is one. Switching costs through their CUDA software programming. Once you get programmers used to using a particular approach in a language, they're not going to want to change very quickly. And I would say one of the key ones for them is counter positioning. When they started out, the world was dominated by CPUs, central processing units, Intel, AMD. So are you going to beat the big boys at that game? No. They went off and did graphical processing units, GPUs, which at the time were for games, but now it's turned out it's been a home run because it turns out the parallel processing you need for those games works fantastically for artificial intelligence. So I'm not sure people fully appreciate that initial decision that they made and how it's paid off over time. Arguably, they may also have something in terms of a cornered resource, in terms of their understanding of artificial intelligence. They're not just doing the chips now, they're getting into the networking and creating complete data centers. And the branding probably matters a little bit less, particularly in semiconductors, but it does matter in tech. People still will say you don't get fired for buying IBM, or maybe these days you don't get fired for buying AWS to be your data center. In the future, you're probably not going to get fired for buying NVIDIA GPUs. So that's to kind of answer your question about how do we think about which companies we want to be looking at.
And Steve, since you've given us this overview of the 7 Power Strategic Framework, you mentioned some names that have been around for decades and through different cycles. So when you're thinking about a long-term investment horizon when it comes to the tech names, we know Intel, we know Apple, and as you mentioned, NVIDIA, some of these names have survived and gone through many cycles and ups and downs. So if you had to take a look at these names and rate their performance in terms of how they have been able to survive and innovate, what is your assessment?
So I covered the hardware companies, so IBM, Sun, Dell, HP, Apple. Hardware is not the sexy part of technology, and that's been true for a long time. It's kind of migrated to the internet, to software. Now even semiconductors are quite a bit hotter. And yet, companies like IBM and Oracle have survived through many cycles. Many of them have succeeded because of that switching cost. IBM was the dominant computer company in the 80s. Its relative performance of the stock to the market actually peaked in 1987, but the companies continued to do fairly well. The stock in the last 12 months actually has been quite good as they've gotten rid of parts of their services business and actually are growing revenue. But the reason that they were able to buy time is because of the switching costs. People locked into their System 360 operating system, and hard to take all that corporate data off the mainframe onto Windows servers or whatever it might be, Sun Unix boxes. Oracle, a little bit of the same thing, right? Oracle kind of viewed as a long in the tooth software company, but they own the database. That's where your key company crucial data is housed. Very hard to extract that. That's bought them time, so now suddenly they're a fairly important cloud player. Microsoft, another example, right? Microsoft, in a sense, peaked 20 years ago. They had the justice suit and all that kind of stuff. Ballmer came in, they started to go for Nokia phones, and they were just off on a total wrong tangent. But they came back to their enterprise customer. They still had tons of enterprise software out there, and they leveraged that with cloud. So cloud turns out to be a huge enterprise data center opportunity for them with Azure. Instead of running your data center on-prem, you run it off-prem at AWS, Microsoft, Google Cloud. So that's given them new life, and now of course they're invested in OpenAI. So they're the exception. I would say those three are the exceptions to the rule. There are other companies that have made it through by remaking themselves. But as Clay Christensen taught us, disruptive technologies usually get you in the end. And the reason is not because your management's dumb, it's because they're listening to their best customers. And their best customers want a better mainframe if you're IBM, a better mini computer if you're DEC, a better PC if you're Compaq. And yet the market moves on to new things and to lower margin things quite often. And as Jeff Bezos said, your margin is my opportunity. So for the traditional companies, their margin becomes somebody else's opportunity. There's plenty of companies that I won't list that didn't make it, but I'm somewhat infamous for having written one of the first kind of open letters, as they call them these days, to, at the time, Scott McNeely at Sun, kind of arguing that they had to make some big strategic changes and he had to hire a new COO and all this kind of stuff, which I don't think was fully appreciated at the time by the company, but I think turned out to be fairly true. And the stock tanked, and eventually they had to sell out to Oracle.
And Steve, as you mentioned, some very familiar hardware names that you have covered over the years, but you do have a storied reputation that does follow you. So I know that you've talked to many management teams over the years for the companies that you're covering. Before we move away from the 7-Power Strategic Framework, what would you say are some examples of companies where this wasn't applied in the best manner, and as a result of that, the company learned some very important lessons?
Well, I covered digital equipment back in the day, which at the time was the leading mini computer company. And at one point, they got envious of IBM's mainframe business. And they were like, hey, I think we can get some of that mainframe business. And they came out with a product that didn't sell. Again, in the customer's mind, DEC meant mini computers, not mainframes. IBM was able to block what they did pretty successfully, and it was sort of the beginning of DECs falling apart to some degree, if you will. Another thing to watch out for these days is stock comp. So we've gone through this process over the years of how do you report earnings, right? So yes, we have GAAP earnings, but tech companies tend to fall over themselves to report non-GAAP earnings, which in many cases there's a reason for that. It's useful to kind of look at things that are on a continuous operating basis. But in particular, they tend to hide a lot of the stock-based comp. And one of the companies that I think is particularly bad at this is Snap. Snap, I think, was profitable in 1 quarter of their history. They're unprofitable today, and yet the management team through stock has gotten quite rich. So I think if you look at the message boards, you see a lot of people complaining about what they're doing. So you're only looking for management's common sense that basically are aligned with shareholders. Everybody talks their game, but there's still some people, I think, who are on the right side of the line in terms of having the right incentives aligned with shareholders, and then others who maybe are playing some games.
And I do want to step back and take a look at that 60,000-foot view of tech that you mentioned, as well as the 30,000-foot perspective. So can you refresh your memory and also dive into the 30,000-foot perspective?
Yeah, so the 30,000-foot perspective I would view as those 10 to 15-year waves. And that's become so important because we've seen enough waves now that people have kind of figured out, okay, geez, the mini computer wave's coming, I want to get out of IBM, I want to get into DEC. The PC wave's coming, okay, I want to get into Compaq, I want to get out of DEC. One of the big issues right now, of course, is with the AI wave, what happens to software? I saw a Morgan Stanley report came out the other day where they're arguing there's actually going to be a big 10, 15-year upgrade cycle coming for software. Others would argue that no, with artificial intelligence you can code much more quickly. People aren't going to want to pay tens and hundreds of $1,000s of upping their licenses and their seat fees and so forth. So the question investors have been asking recently is software dead? Now, obviously that's an extreme view. The answer is likely to be somewhere in between, but that's the kind of critical question that you're going to have as you move into a new one of these 10 to 15-year waves.
So what questions should we be asking when it comes to the next wave?
Yeah, so let's talk a little bit about artificial intelligence. So we have, starting with slide 7 here, I'm going to show some slides from Coatue. Coatue is a crossover fund. They do both public and private investing, and they did a really interesting investor update in the middle of summer, and a slide deck which is available on the internet for that, so Coatue. So what they talk here about is kind of how do we break down that 10 to 15 year wave? And they would point out that initially with artificial intelligence, we're in the early stage, we're creating the core infrastructure, which is the semiconductors, the data centers to do the AI training at this point. So it's very hardware centric. We're beginning to move into the second phase where you begin to move this intelligence out to the edge. So Apple's now talking about trying to embed some intelligence into the new iPhones. All the PC companies are now trying to, get on this wave, and we have, Copilot, and we have AI PCs. I'm still kind of wondering if that's a bit of an oxymoron, but in any case, we're moving to the edge. The next wave, arguably, would be something with applications, because with these waves, quite often they do unfold where they start in hardware and they move into software, and then they kind of end up with services. So with AI applications, you're going to have, they're not calling them agents, but you can just imagine, every industry potentially has an application of AI in it. And then finally, you could see AI in physical. So I was watching TV yesterday, and Jensen's on talking about potential wave for industrial AI, and I think this would be another name for that, where you're putting artificial intelligence into real-life objects like cars with self-driving. Robotics certainly is going to be a huge one over time. The recent Meta glasses that were announced are kind of a form of use of AI, so that's maybe how augmented reality becomes something that we actually can invest in over time. So this is one way to think about how we're moving into this AI wave. If we go to the next slide, on slide 8, a big question right now is there's huge investment going into this first stage, right, into these large data centers. So perhaps over to, according to this chart, maybe $2.4 trillion of investment in primarily data centers, and about half of that cost is for GPUs from NVIDIA and others, and about half is for other things. If we want to get a return on that, let's say a 25% return on capital, that would result in about $1 trillion of cash flow over time. And just that $1.8 trillion number relative to other things in the economy, 3% of global revenues and so forth, 2% of GDP. These are huge numbers that we're talking about. So when you're investing in trillions today, the investor has to be asking, okay, when's the payoff coming? When do I see it? And you've got, I think, Microsoft, Meta, other companies kind of saying, hey, look, there's going to be a bit of a gap period here where our margins may get squeezed a bit. It's going to take some time for this to mature. The good news is we saw this with the internet era, right? We have particularly the telecom side, we had all that fiber laid down. It was excess capacity. It was nuts. WorldCom and all that stuff collapsed, but it resulted in the bandwidth that Google and others needed. So the idea today is that the investment's going to be worth it. And all these companies have pedaled to the metal in terms of the investments that they're making. So only time will tell. The financial metric you want to be focused on over time is return on capital. Are you earning your cost of capital? If you are, you're creating value. If you aren't, you're destroying value. And no matter how fast you're growing, you've got to earn that cost of capital. In fact, the faster you grow, if you're not earning cost of capital, the faster you're destroying value. Now, initially in these early stages, you're not going to be earning the cost of capital in AI, but again, the bet from some very smart people is eventually you will. Sequoia, which is one of the famous VC firms, has some papers out also available on the web, and they're showing that there's about a $500 billion, I think it's $500 billion gap of revenue today in terms of what's been invested. And to get that, say, 20-25% return, how much revenue are you going to need? Well, today we don't have much, right? OpenAI has 3 or 4 billion. There's a few other billion on top of that. So we need something like 500 billion of incremental revenue to justify to get a return on the investment that's being made. So we'll all be following that very closely. But I think it's likely to pay off in some form longer term. If we go to the next slide, just to see the investment opportunity and how it's shifting as we shift waves. As I mentioned, the last 10 to 15 years have been very software driven. So names like, beginning with Salesforce, of course, Workday, Snowflake, and others. The SaaS index has done incredibly well, software as a service. But now as we've entered the AI wave, it's been really driven by semiconductors. NVIDIA, but also AMD, Marvell, and others. So again, as we saw early in this wave, you're likely to see it being fairly hardware-centric semis, and to some degree the cloud players. And then finally, if we go to the last slide, slide 10, this is where Coatue looked at AI stocks with at least a 25% return year to date. And they identified 23 names, 33 names. 17 of those are semiconductor companies. So NVIDIA and GPUs, Apple and PC companies perhaps, and edge AI. Foundry might be TSMC. Semiconductor capital equipment, ASML, KLA. Memory, Micron, networking, Arista. So there's obviously a lot of tech ways to play this and beyond semiconductors. But I think the new thing is that there's a lot of non-tech ways to play this trend as well. A number of industrial names, probably in the data center, that help you create the full data center. And the big one, of course, is we need more energy. You're starting to invest in utilities as a tech play, believe it or not. Energy companies over time. So we're seeing 3 Mile Island nuclear plant coming to life again, just to give Microsoft some new data centers. So you've got to start to broaden that aperture as an investor beyond classic tech if you want to take advantage of the AI trend.
So a few things that stood out to me. I do want to expand on what you were talking about in terms of gap, in terms of revenue, and what this would look like for an investor in terms of time horizon, so in terms of return on investment. So if somebody is looking at some of these names for an AI play, what does that look like in terms of a time horizon for investing?
Well, I guess it depends on the type of company. Semiconductor companies clearly can be benefiting today. Now, you've got to dig a little deeper and sort of see how much of that revenue is truly AI driven, right? Because you see all these kind of Google search results and looking at earnings calls and how often AI is mentioned and so forth. So everybody's trying to put an AI coating on everything these days to get a higher PE multiple. So you certainly have to look underneath that and see what's real. But for the semiconductor companies, a lot of that is real, and a lot of it's now, and probably over the next 3 to 5 years for sure, and then going out over time. For a software company, it's on the other hand maybe more of a threat in the near term. Trying to figure out to what degree are coders more productive using AI. The number seems to be not 100%, but 20 to 30%. Does that mean that I need fewer site licenses and so forth? On the other hand, many of these companies are claiming it's going to ultimately benefit them through software agents and so forth. Then you even have services. Yesterday, Jensen announcing a deal where NVIDIA and Accenture are going to be working closely together. Services tends to have a bit of a longer tail to it. For the established companies, the good news is that they have seen previous disruptions. So companies like Google and Meta and so forth, you typically would say, oh, they're going to be disrupted by this new stuff, because the old companies usually aren't good at the new stuff. But they've seen what's happened in the past, and so they've been quick to jump on these trends. And if anything, as we talked about, maybe they're over-investing in the trend and creating an AI bubble. But you got to give them credit for really moving those ships in a quick direction. For small companies, I'm going to bring up something you're never going to hear from somebody else. But it goes back to that kind of marketing thing that I mentioned before, which is company names. I believe company names are very important. And there's good and there's bad names. Bad names tend to be common names. A common name would be a category name. And this was very typical back in the dot-com bubble, right? So everybody thought, well, I'm going to own the pets category by calling myself pets.com.
Yeah.
Wine.com, garden.com. So, I mean, it kind of makes sense. Yeah. But if you look at the companies that came out of that period, it's Yahoo, Amazon, proper names. So it turns out, I believe, that the idea is that what you want to do is create the most powerful thing for a company is to create a category. You want to be a category creator, and you want to proliferate that category, but you want your company name to be the leading brand within that category, a proper name, not the name of the category. And if you're super successful, they sort of almost name the categories for you, like Xerox, go Xerox that.
Yeah.
Or Remy, go Google that for me, right? So that's kind of the ultimate mind share game that you can get. So I would watch for particularly some of these smaller companies to see, do they have good names? One of the companies in AI that's trying to do something interesting is Grok. It's G-R-O-Q, this one, whereas Elon has his Grok AI, so that's a little bit confusing. but it's a proper name, and they're doing a counter positioning. They're saying, look, what NVIDIA is really good at with GPU chips is training, right? There's two types of work for AI, training and then inference when you actually put it into implementation. So most of it's been training so far, and NVIDIA is fantastic at that. Inference, though, arguably could require cheaper semiconductors, a little bit of a different approach. Grok is saying we're going to focus on that and disrupt, in a sense, NVIDIA as they try to move into inference. So that's highly debatable, but I'd be watching for new names, how they name themselves, what's their strategy, is it counter positioning, what are they trying to do, and how aligned is management with what I care about.
And Steve, it's funny that you mentioned searching for AI in an earnings call or even perhaps an annual report, because if you don't have an analyst or associate working for you or with you, you can actually use AI to search for these terms, right? So yeah, before I let you go, I do want to ask you about the data center part of the AI play. You mentioned industrials and how these companies also have exposure. So for people who might be wondering, what does that actually look like in terms of these companies? You mentioned 3 Mile Island and what Microsoft is doing just because of the need for energy as they move forward. So tell me what you're looking at when you're focused on the industrial play.
Yeah, that's a good question, and I'm not quite sure what specific industrial companies they're talking about. I'm sure some of them have components that do play in the data center or maybe in the distribution side. Many of them I'm sure work with utilities in terms of transmission and so forth. I have to say, as somebody who started with mainframe computers, I'm very excited to see the data center have this renaissance, right? It looked like everything was kind of going out to the edge, but over the last 10 years, of course, we've had the cloud, which has reinvigorated the data center. Now we've got even bigger and better data centers with thousands of GPUs. It's hard to imagine. I don't know if some of you have watched the Silicon Valley TV show, right? But they had pictures of the Hooley data center. It's just like fields of servers, and I imagine that's what it's like. And increasingly, you're going to want to put these in maybe rural areas. It's all going to be about what am I close to? Am I close to water, hydropower? Clearly, nuclear is going to get a big boost out of this.
Yes.
And there are companies, trying to now do sort of small nuclear, and hopefully, we're going to start to allow regulation to do this faster. But it's funny how I actually did clean tech analyst for a couple years, and which was very frustrating 10, 15 years ago with solar and so forth. But nuclear was considered bad. Now it's considered green, which I think it should be, right? So there's going to be nuclear plays on this eventually as well. But it's great to see the data center come back, and there's going to be a wide array of plays likely in the industrial and service sectors on this trend.
Well, Steve, I could go on and continue talking with you, but thank you so much for joining me here on set at the New York Stock Exchange, and thank you for sharing your insights.
Thank you, Remy. Really appreciate it.
My pleasure. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SAMPRO TV, and you can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us, and have a great day.